Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Xplr Infrastructure Lp annual report. Xplr Infrastructure Lp offers a range of businesses and services that cater to the energy sector in the United States. At its core, the company operates in the energy selling business, providing clean energy solutions through various contracted assets. These include wind, solar, and battery storage projects, which contribute to a cleaner and more sustainable energy mix. In addition to these renewable energy sources, Xplr Infrastructure Lp also invests in contracted natural gas pipeline assets. This diversification of services allows the company to provide a comprehensive range of energy solutions to its clients. By leveraging its expertise and resources, Xplr Infrastructure Lp is well-positioned to meet the evolving needs of the energy market. The company's portfolio of contracted clean energy assets and natural gas pipeline investments enables it to offer a unique blend of services that cater to various client requirements. Whether it's providing renewable energy solutions or investing in contracted natural gas pipeline assets, Xplr Infrastructure Lp is committed to delivering reliable and efficient energy services to its clients. The stock price of Xplr Infrastructure Lp has increased by 27.24% over the past year, a significant rise that can be attributed to several key news events. One major contributor was the company's strong fourth quarter and full year 2025 financial results, which showed positive net income and robust adjusted EBITDA. The completion of Xplr Infrastructure's 2-year financing plan ahead of schedule also played a crucial role in its stock price increase. This achievement simplified their capital structure by addressing over $1.1 billion in convertible equity portfolio financings, CEPFS. Furthermore, the company's strategic repositioning and growth initiatives, such as expanding its repowering plan to 2.1 gigawatts through 2030, are expected to deliver strong equity returns and enhance the value of its portfolio. Additionally, Xplr Infrastructure's debt management efforts have contributed to its stock price increase. The company raised approximately $1.6 billion in project financing commitments and reduced its corporate debt issuance for 2026 by $250 million. This proactive approach has improved the company's financial flexibility and stability. The shift to a self-funding growth model, announced in early 2025, has also had a positive impact on Xplr Infrastructure's stock price. By suspending distributions to unit holders indefinitely, the company aims to maximize unitholder value through disciplined capital allocation. This strategic move has signaled a focus on long-term sustainability and growth. Finally, the successful tender offer for senior notes and the pricing of new senior unsecured notes have demonstrated Xplr Infrastructure's proactive approach to debt management, further contributing to its stock price increase. Overall, these key news events have collectively contributed to the company's positive performance over the past year. Xplr Infrastructure Lp maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Xplr Infrastructure Lp trades at a lower price-to-book ratio of 0.31 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 37% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 34.75%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth and decline for companies like Xplr are multifaceted. On the growth side, Contracts with major utilities such as Pacific Gas and Electric Company and Southern California Edison Company play a significant role, accounting for a substantial portion of consolidated revenues. Additionally, long-term secular growth in U.S. electric power demand due to various factors such as data centers, onshoring of manufacturing, and electrification of industry contributes to revenue growth. Government incentives like tax credits, cash grants, and RPS programs also support clean energy projects, driving revenue growth. Furthermore, repowering renewable energy projects, investing in co-located battery storage projects, and acquiring clean energy assets in regions with favorable locations and expected power demand growth are key drivers of revenue growth. Organic growth opportunities at existing assets through renewable energy repowering, geographic and resource diversification, and performance of renewable energy projects also contribute to revenue growth. On the other hand, revenue decline is driven by factors such as absence of customer settlement payments on early termination of PPAs, lower revenue due to unfavorable wind resources, timing of transactions impacting working capital, and delays or inability to obtain necessary permits. Failure of customers to fulfill their contractual obligations due to financial difficulties or insolvency, changes in laws, regulations, or policies that promote and support clean energy, negative publicity affecting customer relationships, and unanticipated cost overruns also contribute to revenue decline. Adverse conditions in the energy market can also impact revenue growth and stability. The net income of a company underwent significant decline between 2023 and 2025. The net income decreased by $654 million, dropping from $218 million in 2023 to minus $436 million in 2025. This substantial decrease indicates that the company incurred a net loss of $436 million in 2025, which is an increase from the previous year's net loss of minus $411 million. The profit margins also suffered during this period. The operating loss increased from minus $28 million to minus $186 million between 2023 and 2025. Furthermore, the operating expenses as a percentage of operating revenues rose significantly, reaching 117% in 2025 compared to 102% in 2023. This increase in operating expenses relative to revenue suggests that the company's profit margins likely decreased due to increased capital expenditures and suspended cash distributions. The reasons behind these changes are not explicitly stated, but can be inferred from the provided information. The significant decrease in net income and profit margins indicates a challenging period for the company, which may have been exacerbated by increased expenses and reduced revenue. The company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health. According to the provided information on page 38 and page 51, the company has consistently produced positive operating cash flows in the years 2023, 2024, and 2025. In 2023, the company generated $800 million in net cash provided by operating activities, indicating a strong ability to generate cash from its core operations. This trend continued in 2024, where the company produced $739 million in net cash provided by operating activities. Although there was a slight decrease in 2025, with $731 million in net cash provided by operating activities, it is still a positive indicator of the company's financial performance. Overall, the data suggests that the company has been able to generate sufficient cash from its operations to support its growth and investments, which is a testament to its financial stability. The company's debt level has undergone significant fluctuations over the past few years. Initially, it was reported that the debt level had increased due to substantial indebtedness, page 18. However, subsequent reports revealed a decrease in total debt from $7,426 million in 2024 to $8,696 million in 2025, page 50. This apparent inconsistency can be attributed to various factors such as repayment of debts and changes in financing activities. For instance, net cash used in financing activities increased from minus $2,002 million in 2024 to minus $674 million in 2025, page 51, indicating a reduction in debt levels. Regarding interest expenses, the company has experienced an increase over the years. In 2023, interest expense was reported at -$25 million, which rose to -$56 million in 2024, page 67. This represents an increase of $31 million. Furthermore, interest expense continued to rise in 2025, reaching -$71 million, a $15 million increase from 2024. These changes suggest that the company's debt level and interest expenses have undergone significant fluctuations over the past few years. Management is optimistic about the company's outlook, citing anticipated long-term growth in U.S. electricity demand as a key driver of opportunities for investment. The company plans to capitalize on this trend by investing in existing portfolio through renewable energy, repowering projects, and co-located battery storage. In addition to organic growth, management sees potential for adjacent investment opportunities driven by the secular growth in U.S. electric power demand. This growth is expected to be fueled by data centers, onshoring of manufacturing, and electrification of industry. The company's primary objective is to deliver value to common unit holders through clean energy investments. To achieve this goal, management plans to invest cash generated by existing assets in organic growth opportunities and selective acquisitions. The company's competitive strengths, including contracted projects with stable cash flows, geographic and resource diversification, and access to diverse financing sources, position it well to execute its strategy and deliver value over the long term. Management is also evaluating options for the assets underlying Xplr Renewables III, LLC, including a potential sale. However, this does not appear to be a major focus of the company's strategy at present. Instead, management is focused on delivering revenue growth, with projected energy sales revenue of $1,155 million in 2024. Overall, management's outlook is positive, driven by expected growth in U.S. electricity demand and the company's competitive strengths. The company's financial performance is reflected in its dividend payments. According to the provided information, the company has a history of distributing significant amounts to its shareholders. In 2024, it distributed approximately $335 million, while in 2023, it distributed around $309 million. These figures indicate that the company prioritizes returning value to its investors through dividends. Concerns about inventory buildup and supply chain disruption are present in specific contexts. Changes in international trade laws, regulations, agreements, treaties, taxes, tariffs, duties, or policies can lead to inventory buildup, page 13. Public health crises and epidemics or pandemics can also cause supply chain disruptions, page 18. Additionally, lower payments from subsidiaries under the CSCS agreement may indirectly contribute to inventory buildup concerns, page 39. Furthermore, Xplr's buyout of remaining Class B non-controlling membership interests in certain entities could lead to supply chain disruption, page 90. That concludes the financial summary for Xplr Infrastructure Lp. Feel free to comment below, and I will be happy to answer them when possible.